Hi there, welcome one and all to another live webinar with us from Phillip Nova. This is Sri, your facilitator of the day. And what will we be discussing today? We will be discussing how you can diversify your portfolio and get ahead in the ETF investing game. As you know, Singapore is surrounded by sound policies, and we have the strong, robust Singapore market backing the country. The outlook for the Singapore investment opportunities have shown brightly as a safe haven among global uncertainties that we see in several regions around the world. Against this backdrop, income, growth, and stability are expected to be the key anchors for investors. APAC Financials have also been deepening their strong fundamentals to bolster growth opportunities while providing stable dividends. And today, we'll be hearing from Ong Xun Xiang, the ETF Business Lead at Lion Global Investors, as he shares why the Lion-OCBC Securities APAC Financials Dividend Plus ETF can be the building block for investors to gain APAC financial sector exposure and access income and growth. Okay, these are key things that we are looking for in this stage as investors. He also cover how he also touched on the Lion OCBC Securities Singapore Low Carbon ETF and how potentially it can be a long-term winner for your portfolio and allow you to diversify while doing good for the planet. All right, so I shared earlier, Ong Xun Xiang is the ETF business lead for Lion Global Investors, and he is responsible for driving the ETF business through building and commercializing ETFs, which includes speaking at ETF events like this to equip the public with investment and industry knowledge. Su Xiang has a wealth of experience in various roles across asset management, private banking, and fintech. And prior to joining Lion Global Investors, he was a Capital Markets Assistant Vice President at ADDX, formerly iStocks, ISTOX, MAS licensed digital securities platform, empowering investor access to private capital opportunities. Before that, he was an Assistant Vice President at BNP Paribas Wealth Management's key client group, where he helped to originate, manage, and drive private market investment opportunities for ultra high net worth individuals. So basically, gentlemen, we have a guest who is well informed about the market and is the right person to share with you potential opportunities that you might be interested in. So just stay tuned and do join us in this live webinar. All right. So before we kick things off, um, let me know if you can hear me loud and clear by typing yes in the question box, and I'll hand the time over to Sun Jiang to walk us through what he has to share with us. All right, you just go to your control panel. You'll see a question box there. Type yes if you can hear us loud and clear.
Okay, thank you, Sri, for the introduction. And before I start, can I confirm my screen is visible to you? To, to you, Sri?
Yeah, it looks good. Over to you, Sun Jiang.
Okay, thank you so much. Thank you for the introduction and good evening, everyone. And thank you for spending your evening with us. I'm Xun Xiang from Lion Global Investors and can call me LGI's ETF guide. So I'm here today to share with all of you how you and I can diversify our portfolios through two key building blocks that have outperformed the STI since inception. So the first one would be this ETF, which is the Lion-OCBC Securities Singapore Low Carbon ETF that has been the best performing ETF among Singapore equities ETF in year 2023. It's also until now the best performing Singapore equities ETF listed on the SGX in 2024 as of 31st August and has outperformed the Straits Times Index since its inception. So it's a very wonderful and unique form of the Singapore equities ETF. And another one would be our newly listed APAC Financials Dividend Plus ETF that promises and gives 5% per annum in terms of quarterly distribution. And before I deep dive into ETFs, I'll first introduce a bit about Lion Global Investors in case some of you are not do not know us yet. So we are one of Southeast Asia's leading asset managers, and we are the asset management arm of OCBC Group. So because of this, we are technically part of the OCBC Group. We are part of a financial conglomerate that's well covered with different arms that's also well supported. And we are one of Southeast Asia's leading asset managers. We manage around 69 billion Sing dollars of assets for our clients. And you will notice that currently you have 6 ETFs, and we started our ETF journey back in 2017 when we listed our first ETF, which is the Lion Phillip S-REIT ETF. And since then, between 2020 to 2022, we listed 3 ETFs within 18 months. So 3 ETFs within 18 months. And this year alone, we have actually already listed 2 ETFs on the SGX. One of it is the Japan Active ETF powered by AI, and also the other one would be the APAC Financials Dividend Plus ETF. And in fact, if you apply the cutoff as of the end of 2023, you will notice that 4 out of our 8, out of our 6 ETFs, 3 out of our 4 ETFs, actually, as of the end of 2023, were the top returning ETFs among their respective segments like REIT ETFs, China equities ETFs, and also Singapore equities ETFs. And all these are because we are committed to building quality ETFs and quality investment solutions for Singapore investors. And based on SGX data, you'll notice that among the top 10 ETFs held by retail investors like everyone, including myself, we are among the top 10. And within this segment for SRS investors, we are also among the top 10, as you can see here. And based on trading turnover, last year, our ETFs are also ranked within the top 10 by trading turnover. And all these are because we are Singapore incorporated, we are a homegrown Singapore ETF issuer. And that's why we built our ETFs and our investment solutions for the Singapore investor in mind. And when we talk about Singapore is an interesting landscape, interesting country, other than us being Singapore incorporated like Phillip Nova here, we find a lot of commonalities when we build our investment solutions for the Singapore market. So for Singapore, it's a special country because it is a country when we talk about commitment to net zero. It's a country that has actually done a lot, despite it being a small nation. It's our home. It's a little red dot, but it is also a country that has pledged to achieve net zero by 2050. And it's an interesting commitment because it's actually a very stretched target for a lot of for many of us to be able to reach net zero by 2050 because there are a lot of there are not many options we can use to deploy renewable energy. And even though Singapore actually only just accounts for around 0.1% of global emissions, our DPM back then, right now he's PM, mentioned that Singapore wants to do our part to tackle the global issue of climate change. And all this makes us not just a little red dot, but also a little green dot within the whole global landscape. And this is because climate change affects everyone. And there are basically 2 types of climate risk involved. The first type is physical risk, which is more easily understood and more prevalent because we have seen the loss of lives, loss of wealth through different natural disasters, typhoons that we have seen over the years in increased frequency. The other climate risk is less appreciated, but also important within the whole fight against climate change. And this is about transition risk because it's actually brought about by policymakers. When we and one example would actually be, for example, in the 2022 Singapore budget, Singapore recently introduced increase in carbon taxes. And for those companies that are unable or unwilling to reduce their carbon footprint, they may face reduced funding or higher funding costs. And all these could be reflected in their share price. So all these are actually investment risks, which we are not aware of, but we need to protect ourselves against these investment risks. And that is why we decided to come together and build the Lion-OCBC Securities Singapore Low Carbon ETF. And the fundamental reason is because it's meant to be a more green version and also a more modern version of the Straits Times Index, which was built back in 1960s. And because of this, we wanted to build something that's more reflective of Singapore's real and financial economy, and also capture constituents not just listed within Singapore, but those also listed in the US and Hong Kong. So it's more holistic, and also at the same time help investors reduce their carbon footprint. And this ETF tracks the IHOCBC Singapore Low Carbon Select 50 Capped Index. And there are three key features I want to share with all of you. First is about its investment in the 50 largest Singapore companies that are committed to a lower carbon footprint. And second, there are weightage caps to take note about. For example, the 7% weightage cap if the total market cap is below USD 200 billion, and a 10% weightage cap, which we take into account during balancing if the market cap rises above USD 200 billion. And another unique point about this ETF is that it actually pays a semi-annual distribution, which is announced around every June and December. So in fact, we recently paid this semi-annual distribution back in June. And like our APAC Financials ETF, which some of you might be aware that we recently made a special distribution back in July for our APAC Financials ETF. And whenever we see potential capital gains, we might opt to make special distribution for our ETFs to help investors lock in potential capital gains. And this ETF tracks the IHOCBC Singapore Low Carbon Select 50 Capped Index, which aims to track the top 50 companies by free float market cap. And this focuses on decarbonization by reducing the weighted average carbon intensity. So weighted average carbon intensity sounds complicated, but it's basically the carbon emissions per $1 million of revenue. So the lower the weighted average carbon intensity means the lower amount of carbon emissions per $1 million of revenue. So as of the 31st of August, you will notice that if we compare together with MSCI Singapore, the Straits Times Index, our index, the constituents of our index, emits the lowest amount of carbon emissions per $1 million of revenue. So this part is important because while even by emitting the lowest amount of carbon, we still are able to actually outperform these two indices, which you'll notice in this slide if we compare with our performance with the other two STI ETFs that are listed on the SGX and also the MSCI Singapore ETF. We have outperformed these three ETFs since inception. So this can be clearly seen in this box where we talk about annualized percentage return since the fund's inception. We have outperformed these ETFs since the fund's inception. And we've talked about in 2023, we were the highest performing and best performing Singapore equities ETF. 2024, we have also outperformed the other three ETFs in the whole year. And all these are important because it means that you do not have to sacrifice returns even when you decarbonize your portfolio. And when we talk about another part, not only about decarbonization, there's also this part about sector diversification, which these ETFs offer. Because if you notice, for example, for the Straits Times Index or even the MSCI Singapore Index, it's actually very heavily weighted towards financials. Most of the weightage they have are actually more than 50%. But if you look at our index, you'll notice it's more evenly distributed across various sectors, and it has actually a high weightage towards technology. So this is the part that makes it slightly more growth oriented, and it's important because the inclusion actually of US listed constituents actually help to boost the ETF's performance. So you can see that, for example, just by including C and Flex, which are among the top few constituents of this ETF, they have generated amazing returns this year. So it's a very interesting phenomenon we notice, especially by including constituents that are listed in other countries within the Singapore domiciled companies listed in other countries. So it better reflects the real and financial economy of Singapore. And if you notice that when I talked about including US and also including Hong Kong, we have included actually more countries compared to MSCI Singapore and also the Straits Times Index. So much so that it actually also offers geographical diversification. And this is important because when rate cuts are coming, there might be a stronger, having a higher tech weightage could be important, which to help the ETF potentially perform better than other similar ETFs. And this is also an important point because you have noticed that in fact within the past few months the ETF has rallied a lot over the past few months, and that is what also has helped to increase the returns within 2024 so far. So we are optimistic about this ETF, and you will notice that among the top 20 constituents, a lot of these are household names. For example, like you notice DBS, UOB, and also OCBC. These are the top three local banks, but also you will notice other US listed constituents like C Limited, Flex Limited, Grab Limited. So all these are the US listed constituents that don't pay so much dividends compared to the banks, but at the same time offer greater growth potential. And this is where the potential capital appreciation comes in. So first constituent I'll deep dive into will be C Limited. It's an amazing company achieving a lot of it has achieved actually in fact growth in consecutive quarters, and in its most recent quarter in Q2 it has also been a solid quarter with its strong momentum from Q1 continuing in Q2, and all of these three businesses, C-Money, Shopee, Garena, have demonstrated greater growth and also higher profitability. So in fact, in the most recent quarter, C Limited expects Shopee to be adjusted EBITDA positive. So this is an important distinction because after its restructuring in the past 1 or 2 years, all these are bearing fruit and materializing. And that's where we have seen C Limited increase significantly during the stock price in terms of its stock price to take into account the fruits of its restructuring. So all these are important. And another part is also about Garena, which has continued demonstrating its evergreen franchise. It's the world's most downloaded game and also with more than 100 million daily active users throughout this quarter in Q2. So all these make it interesting growth-oriented company. And so this is, in short, C Limited is more like a high-profile growth company. And in the next slide, which is this slide, when we talk of Flex Limited, it's actually more of a lower profile, value-oriented company. So this company is Flex Limited has delivered also another strong quarter in terms of growth in margin, in terms of profit margins, and also earnings per share. So all these have been interesting for this company, and in its most recent quarter, which is in Q1 2025. So to them, Q1, because their fiscal year starts in 1st of April. So that's why they consider Q1 2025 to be the quarter between April to June. They have announced expectations to preserve their operating margins to around 5.4% and also further increase their adjusted EPS. So it's interesting because they have already achieved its third year of consecutive 20% EPS growth. So imagine a company that actually has grown its earnings per share for 3 years at 20% in each year. So these are making it a high growth but lower profile value company. So it's the interesting thing about this ETF because compared to the traditional STI ETFs that focus more on Singapore-listed constituents, this ETFs adds another angle by including countries and constituents that are listed in the US and in Hong Kong. And all these add the growth element into this ETF and make it more holistic. And by investing in this ETF, what you get also is about you also get to reduce and decarbonize your portfolio, while at the same time gain potentially higher capital appreciation. So this is what to summarize for this whole ETF is a green building block. It has a SGX ticker that also resembles clearly in terms of what it stands for, ESG, and also ESU in terms of the US dollar counter. The distribution policy is semi-annual, being announced in every June and December, and we might announce special distributions as and when we have additional profits to be able to redistribute to investors. All these make it a green building block, which investors can use to access to achieve potentially higher capital appreciation in among Singapore equities ETFs, while at the same time decarbonize your portfolio. So right now, I will move on to the next ETF I'll talk about, which will be the APAC Financials ETF. So for this ETF, I just want all of you to remember two key points about this ETF. The first point is about it being the world's first APAC Financials ETF. The world's first APAC Financials ETF. And second, it offers 5% per annum quarterly distribution. So we recently listed this ETF back on the 13th of May. Until now, it has done very well. We have already made we have already announced two distributions. We announced a special distribution of 3 cents per share back in July, and we have also announced the ETF's first regular quarterly distribution of 1.25 cent in around a few weeks ago in early September. So it's a ETF that has delivered returns, and we have started to build the track record for this ETF by giving out to fulfill the 5% per annum quarterly distribution. And when we talk about financials, a lot of us, when we think about financials, we just think about banks. But actually, the financial sector not only includes banks, but includes companies that provide services and products that focus on the growth, storage, and transaction of money and assets. So think of it, when mankind and humankind first started, we actually were bartering in seashells, and then after that gold, until today's extent where we are already transacting through pay now. And the financial sector is an interesting sector that has already prospered throughout centuries because it is an essential capital provider for economies worldwide. So key thing, essential capital provider. It lends out and provides capital to companies that want to grow, to people who need the capital. So because it is in the business of providing capital to power economies, this makes it resilient. And when we talk about the financial sector, beyond banks, it also includes investment management, insurance, and also brokerages, and also exchanges. So all these make it an ecosystem that helps to smoothen the flow of capital, investment, and insurance, allowing economies to trade globally. So this is what makes the financial sector interesting. Capital provider, but also an ecosystem that smoothens the flow of capital. And when we talk about financial, some of you might be wondering, actually, besides that, there's also a lot of other regions we could have covered, but specifically, why APAC Financials? So in terms of financials as a whole, is already one among the world's most profitable sectors. It's generated like around 12 trillion US dollars in terms of revenue. But within APAC, around 55% of adults are underbanked. And all these represent the largest segment across different regions if we compare even to Europe or Latin America. And because of all these reasons, APAC Financials are able to potentially grow further by serving the underbanked within developing Asian countries. And all these are giving it a lot more room to grow within this region. And APAC also has another thing, which is higher savings rate. It's higher than the world's average savings rate. And also within APAC, ASEAN and Singapore are the key drivers behind APAC's high savings rates. So this part is important because APAC already has, as a region, has much higher savings rates than the global average. And within APAC, ASEAN and Singapore further drive the high savings rates within this region. And out of the world's top 30 banks by market cap, around half of them, which is around 14, are APAC banks. So all these are important because the higher savings rates within APAC helps to improve the economic resilience, for example, by increasing the amount of deposits that can be lent out for APAC banks, and also And all these are important in deepening the foundation for growth. And till now, we have seen the APAC financial sector being a diversified mix of developed and developing markets. And APAC banks until now have been paying usually high dividends. So all these are important in laying the foundation for stable dividend income for this ETF. And when we talk about APAC, the financial sector is an ecosystem that also includes insurance. So the APAC life insurance sector is actually among the world's largest in 2021 and so beyond that. And Asian countries are featured within the top 10 global markets based on the written insurance premiums. So within the next 5 years, emerging markets in APAC, for example, like Indonesia, Thailand, and Singapore, are expected to grow at an annual rate of around 5% to 22%. So these are important facts because it will help to catalyze further growth and presents insurance as a high growth segment within the financial sector. And you'll notice that this ETF's name is APAC Financials Dividend Plus ETF. So to some of you who might be wondering actually what is in the plus. So three key reasons why it's in the plus. The first catalyst will be about cushion profitability. So in the past few years, we have already noticed banks globally posting decade high profits, decade high in terms of return on equities. And all these have been powered by higher interest rates that have improved net interest margins, boosting the sector's profits and also the sector ROE. And we are also in the scenario, as we see, that the US Federal Reserve might be making a rate cut, in fact, in this week, in the next few days. And in this kind of scenario, it's important that we select and choose well-capitalized banks. And that's what this ETF is about because it contains the 30 largest and most tradable APAC financials. Well, and with all this happening, it's important to use and also include well-capitalized banks because they are much more likely to maintain profitability in this kind of scenario that's about to unfold and in the upcoming market volatility we might be expecting. The second catalyst would be the Asian tilt, because more APAC banks are already expected to join the top global 100 banks. And globally, in terms of wealth, is expected to exceed USD 500 trillion this year. And the biggest wealth source is actually expected to come from APAC, which is at around 200 trillion US dollars. So all these are important because they will help to catalyze the growth of APAC financials. And the third catalyst would be the pivot towards capital light models, which are important because they use less in terms of balance sheet but bring higher income. So in the past 6 years, what we have noticed is that transaction activities used actually around 16% of capital, this based on a McKinsey study, but actually brought about 33% of profits for the financials. And because of all these, the financial institutions they are embracing a lot of digital transformation like AI, data analytics to remain capital light. And so much so that companies, for example, like DBS, are mentioning that in their annual report that digital customers are consistently more valuable. And all these are because being capital light and going digital helps to improve profitability. So key thing, being capital light and going digital are important to maintain and improve profitability. And this ties in with the first catalyst about cushion profitability because it mentions that well-capitalized banks are more likely to maintain profitability. So you have to take note, well-capitalized banks, and also at the same time, digital. So these are key catalysts. And within APAC right now, as we speak, the financial sector within APAC financials are actually still at an attractive entry point right now. So if you compare in terms of price to earnings ratio, if we just compare to STI, it's actually around half of STI. STI now stands at around 23 in terms of price to earnings. But for the APAC Financials Dividend Plus ETF index, it's actually at around 11. It's around 11 compared to 23. In terms of price to book, it's at 1.1 compared to 1.5. And all these are because the growth catalysts are long term and they take time to be priced in. And some of you might also be asking, US rate cuts are coming in this week, in fact. So how will it impact and affect APAC financials. So the financial sector I mentioned earlier is an ecosystem with businesses that react differently to rate cuts. So the expectations of US rate cuts could actually drive more investment activity within APAC by redirecting capital towards wealth management activities. So the clearest example locally would be about, for example, DBS in terms of the net fee income reaching a record high of 1.05 billion in Q2 this year. So in Q1, it reached 1 billion Sing dollars, and Q2 it reached 1.05 Sing dollars. It's going higher and higher due to expectations of US rate cuts. So all these actually can benefit APAC financials. And furthermore, a lot of the APAC financials already started protecting their net interest margins against lower rates by increasing positions in longer term fixed rate assets. So for example, Keating also, DBS, already put around 30 billion Sing dollars of fixed rate assets in Q3 and Q4 last year. And all these contributed to its record high of 18% ROE in the latest Q2 quarter. And compared to buying these three local banks solely, what this ETF offers is actually geographical diversification because it covers constituents that are in different countries, and these different countries are at different stages of the interest rate cycle. So I repeat again, it covers constituents in countries that are at different stages of the interest rate cycle. So all of us in a lot of countries are expecting US rate cuts happening. So this could affect net interest margins, net interest income. But there are anomalies. For example, Japan, on the other hand, is expecting BOJ rate hikes. It already scrapped its negative rate policy back in March, hiked interest rates once in July, and is expected to further hike interest rates. So when the whole world, in fact, is looking to US cutting interest rates, Japan is looking to increase interest rates. And all these are important because it could help to increase the net interest margins for a lot of Japanese banks. So one example would be SMFG, Sumitomo Mitsui Financial Group, where the group CEO mentioned in his latest investor presentation that their net interest income is expected to increase by 100 billion yen in this fiscal year because of the BOJ's policy changes in increasing interest rates. So when we talk about all this, geographical diversification will be important. And this is where also the financial sector shows its ability to become an ecosystem that offers geographical diversification towards businesses and also across geographies. And all these have helped it prosper throughout centuries. And this is why we built the APAC Financials Dividend Plus ETF. So it offers and added the income element of 5% per annum quarterly distribution. So it helps to offer potential capital appreciation, cushion out impacts of different market volatility by providing geographical diversification. And this is the world's first APAC Financials ETF. In terms of the index, it tracks the IH APAC Financials Dividend Plus Index that tracks the 30 largest and most tradable financials listed in APAC and is designed to offer access to stable dividend payout. So these are the index universe, which includes countries like Australia, Hong Kong, Japan, Singapore, Korea, Indonesia, Malaysia, and Thailand. So some of the eligible sectors include banking, insurance, investment services. And the last one would be specialty finance and services. So this specialty finance and services is important because it actually includes the digital banks. For example, like C Limited and Grab Limited, which have GXS and also Mari Bank. So if the digital banks become large enough and start paying dividends, they could be included into the index. And all these actually makes this index future proof to include future cash cows when they become big enough. And on the second step, in terms of index selection and weighting, there are two key numbers to remember: the 7% stock weightage cap to ensure diversification across stocks, and also 20% country weightage cap to cap country exposure and ensure geographical diversification. And in the end, what you get is a ETF and also a portfolio of 30 constituents weighted based on free float market cap. And the semi-annual rebalancing happens in March and September, which is this month. And there are three key features of this ETF to help investors focus on income and growth. So in terms of focus, it focuses on the top 30 largest and most stable APAC financials. In terms of income, it offers stable quarterly distribution of 5%. In terms of growth, potential capital appreciation in the APAC financial sector. And this the ETF performance since its listing on 13th of May, yes, already in terms of total returns, return around 7%. And also gave a special distribution in of 3 cents per share in July. We also announced a 1.25 cent distribution in early September. So we are committed to delivering the 5% per annum quarterly distribution. In the climate of decreasing interest rates and decreasing deposit rates and saving accounts rates, we are still delivering 5% per annum quarterly distribution. So this ETF has performed well and will continue being committed to the 5% per annum quarterly distribution. And these are the portfolio characteristics. You will notice that it's well diversified across different countries, for example, like Japan, Malaysia, Korea, Hong Kong, Singapore, our home country, and also Australia. And these are the portfolio constituents. You'll notice that our three local banks, DBS, OCBC, and UOB are among the top 5 constituents. You also notice other constituents, for example, like the Korean financials and also the Japanese financials included within this ETF. And these constituents have actually performed well since its inception. For example, Sumitomo Mitsui Financial Group and also KB Financial. These are the potential diversifiers compared to solely buying the Singapore banks. So I'll talk about deep dive into 2 key constituents. The first would be Sumitomo Mitsui Financial Group. It's one of Japan's mega banks. It's similar to in Singapore, we have the 3 largest local banks. Within Japan, they also have a few of the larger mega banks. And within SMFG, which is Sumitomo Mitsui Financial Group, it expects the net interest income to increase by 100 billion yen because of the BOJ rate hikes that have already, one of it had already happened in July this year. So in the most recent quarter, because they're in Japan, the most of the fiscal year starts in 1st of April, SMFG already achieved record high in terms of net business profit and also bottom line profit because of higher loan income. So an interesting thing is in the previous fiscal year, which ended around 31st March 2024, SMFG actually had around 58 trillion. 58 trillion. So it's around 20% of its total assets, parked with the Bank of Japan, which is the central bank's current account. So at that time, when it actually had a 0.1% annual interest rate, they earned around 58 billion just from interest income alone. And this 58 billion was already around 6%. So imagine if there's another 0.1% rate hike. So this 58 billion will become more than 100 billion. So that's where they are able to factor in terms of net interest income, the increase. And so at the same time, their net interest margins also increase. So that's why they are directly reinforcing this that they already expect net interest income to increase within the current fiscal year. And all these are important because they are consistently reinforce its ambitions to reach 1 trillion yen in terms of bottom line profit by the current fiscal year, which ends around 31st of March 2025. Because of this, you will notice that there's a lot of upside potential identified by a lot of analysts. Next company will be also one of Korea's largest financials. So you'll notice that I've been talking about the largest within the respective countries because it's meant to include the large cap companies, large cap financials in each specific country, but kept the total weightage at below 20% for the entire country. So all these are expected to bring the giants, the financial giants of the different countries into the ETF. So for KB Financial, which is also one of Korea's largest financial conglomerates, they have achieved record high in terms of gross operating profit in 2023. So KP Financial is an interesting constituent company. In August 2020, it actually acquired Prudential's South Korean unit, South Korean insurance unit for around USD 2 billion. And the merger was effective at around January 2023. So because of this, you will notice that actually after January 2023, the share price actually shot up by quite a lot at around 80 plus percent, if you notice, from 40 plus thousand to more than 80,000 at 80 plus percent within the past since January 2023. So it's at around the past 20 months at around 80 plus percent in the past 20 months. So because and also there are other reasons why KP Financial was a worthy constituent because it has grew its net profit at more than 8% in the past 4 years. And KP Financial is an interesting company because it approved its share buyback scheme at 320 billion won back in February. And after that, its board, the KP Financial board, further approved another 400 billion won share buyback in its July resolution. So 400 billion plus 320 billion adds up to 720 billion won. So it's cancelling and buying back 720 billion won of shares in 2024. So all these are expected to further improve the share price. And besides this, they also have been consistently announcing and providing stable dividends. So this is the kind of company and the kind of constituent we include into the ETF to make it to lay down its foundation to pay stable dividends for this ETF. And as of June, it's remained well capitalized at 13.6 CET1 ratio, is the highest within Korea's domestic market. And remember, much earlier I mentioned in the one of the first catalysts in the in Catalyst 1 that well-capitalized banks are more likely to maintain profitability. So this is a clear example of having well-capitalized bank to maintain profitability and at the same time be able to grow profits year on year. So to summarize, the APAC Financials Dividend Plus ETF is an interesting company. Two key points to remember. It's an interesting ETF with two key points. World's first APAC Financials ETF and helps you focus on income and growth by focusing on the top 30 largest and most stable APAC financials, offering a stable 5% per annum quarterly distribution, and also providing potential capital appreciation in the APAC financial sector. So the SGX tickers are easy to remember. YLD sounds like yield because 5% is a good yield. We hope you use this ETF to earn stable dividends and invest in APAC financials. So I've covered a lot today. Two key building blocks: the APAC Financials Dividend Plus ETF. YLD is the Sing Dollar ticker. Sounds like yield. 5% per annum quarterly distribution. I also covered earlier about the Singapore Low Carbon ETF. The ticker is ESG. Also, it closely resembles the key message and value proposition is supposed to stand for ESG. And you will notice that among the top 5 constituents of both ETFs, our 3 local banks are actually both within the top 5 constituents. So this is where you also see familiarity in these 2 key building blocks. And we hope you use them to diversify your portfolio and get ahead in the ETF investing game. So thank you everyone for being a great audience. I'll pass the time back to Sri now.
All right, members of the audience, this is your chance to ask our speaker, Mr. Xun Xiang, questions that you have about the ETF products which he has shared with you today. And before we jump into the Q&A, or if you need time to ask your questions, I will give you about 2 minutes to share your questions, and then we will go to the Q&A segment. In the meantime, I would like to share some slides with you. basically details of upcoming webinars that we have, as well as learning resources that you may be keen on. So I'm just going to put up my slides in a moment. Just give me a second. Okay, you should be able to see my slide here. Okay, the first thing I'm going to share is we have a Chinese webinar coming up. Xiang, let me know if you're not seeing the right screen. So we have a Chinese webinar that's coming up very soon on the 19th of September. If you're keen to participate in the webinar, you can just scan the QR code here. Okay, and then next one I would like to share with you is just like the yield is a big hot topic in the markets right now. People are closely monitoring the yen as well. So if you're keen on learning about the Japan market and the yen, don't miss the opportunity to join this webinar on the 24th of September. Okay, and if you like more learning resources for building your ETF portfolio, we have a free ebook here. It is free. If you are not sure of how to get started with ETF investing, and if you want more learning resources, this is your opportunity to do so. Okay, and just to sum up, Phillip Nova offers the Phillip Nova 2.0 suite. You can trade on desktop, your laptop, your mobile, and your tablet. You can trade ETF, stocks, CFD, FX, futures, and options on Phillip Nova 2.0. If you'd like to try a demo, the QR code is there. Please scan the QR code and request a demo. Okay. All right, since Young, I'm done with my sharing of the slides. I'm gonna give you, let's dive, let's see if there's any questions from the members of our audience. Okay, we have a question from Serene. Do you see the questions on your end? Hey, sorry, Since Young, I think you're muted. Maybe you could turn on your mic.
Yeah, the returns are net of management fee.
Yeah, so would you be able to address Serene's question on the return on ETF? Is that the net of the management fee?
Yes, it's net of management fee.
Okay, so that's our first question. We have time for more questions, members of the audience. This is your chance to ask any questions that you may have on the products that Sun Xiang shared with us. Maybe Sun Xiang, maybe you can touch on our key takeaways for today. What do you want us to leave with following this webinar? And maybe from there we can have some questions.
Okay, can. So, in terms of the key takeaway message I have is that the Fed rate cuts are about to happen especially some way might already happen, might already come in this week. So because of this, more market volatility is expected to happen. And in this kind of scenario, it's important to invest and diversify your portfolio through building blocks such as the Singapore Low Carbon ETF and also the APAC Financials Dividend Plus ETF. So for the Singapore Low Carbon ETF, key point is outperform the STI since its inception. So the STI has recently hit record high within the year, and similarly, our ETF has actually also hit record high. It's outperformed the STI, which recently hit its record high, and been the best performing ETF among Singapore equities ETF in 2023. 2024 year to date, it has also been the top performing Singapore equities ETF. So we hope you can consider this while at the same time decarbonize your portfolio through this ETF. This is about the Singapore Low Carbon ETF. Ticker will be ESG and ESU. So for the next ETF, it will be the APAC Financials Dividend Plus ETF. Two key points to remember. It's the world's first APAC Financials ETF. And second, it offers a stable 5% per annum quarterly distribution. We have announced a special dividend back in July because the ETF's unit price reached actually around 1.09 at around 2 months after its listing. So that's why we announced a special distribution of 3 cents per share to help investors lock in capital gains. And this is the approach we expect to continue, not only within the APAC Financials Dividend Plus ETF, but probably also in other ETFs whenever we see potential opportunities. And another point about the 5% per annum quarterly distribution is that we already announced the first quarterly distribution in around 2 weeks ago in early Sep. And we are expecting to pay it at around end September. So we will announce this quarterly distribution in each quarter in June, in September, in December, and also in March. So these are the months to take note of. So this will be where the quarterly distribution cycle will come in for the APAC Financials Dividend Plus ETF. Thank you.
Sun Chang, can I just check? Typically with ETF products, you have the contract that's in US dollars and in Sing dollars. I've always wanted to know, like, how does it impact the investor, or which one should they choose?
Okay, I think in terms of the trading counters, depends based on the currency you hold. Usually, if you hold which I believe a lot of Singapore-based investors, if you hold Sing dollar, it could be better to invest in the Sing dollar counter because it's really what you hold. But if you happen to hold some US dollars, you can also invest and buy and sell the USD counter, which both ETFs currently have.
Okay. In terms of these contracts that you have, um, what are the investors based on investors that you spoke with? What are they very excited about, or what are some of the reasons that draw them towards these contracts?
Okay, in terms of the trading counters, most investors we notice they are more attracted towards the Sing dollar counters because of one key reason. Because Sing dollar counter can the SRS investors, those with SRS monies, can use their Sing dollar SRS monies to buy the ETF in Sing dollar trading counter. So because some of them, if they have SRS monies, and SRS monies can only be in Sing dollar. They use it to buy the Sing dollar counter. So this one aspect why they find it more easy to use for the Sing dollar counter compared to the USD counter.
All right. Thank you so much, Sun Xiang. Members of the audience, if you still have any other questions, you can send them via the survey form at the end of the webinar. Or if you wish to send us more questions after you have thought about the various products that Sun Xiang shared with us today, and you have questions after the webinar, do look out for our follow-up email where we will share the recording to this webinar and you can revise what was covered. If you have questions, then you can just simply reply to the email and we will address your concerns right away. Once again, thank you so much, Sun Xiang. We look forward to having you here again and telling us more about the various ETF opportunities that we should take note of. We hope you had an insightful sharing. Members of the audience, once again, thank you, Sun Xiang.
Thank you, Sri. Thank you, everyone. Hope you have a great evening ahead. Thank you, and happy Mid Autumn to everyone. For those of you
Oh,
who celebrate.
yes. Happy Mid Autumn. I hope everyone has got your slice of mooncakes as well. And all the very best in your trading for the rest of the week.
Hey, thank
Good
you.
night.
Thank you. Cheers. Bye.